Welcome to Smiles and Cents, where we talk dentistry, money, business, and life outside the chair. I'm Ian with Dental Wealth Partners, and as a reminder, this podcast is for entertainment purposes only and not to be taken as investment advice. With that, let's get started. All right, I got Dr. Richard Lowe again on the Smiles and Cents podcast. Always great. Appreciate your questions and always taking me down different paths. And so last time we brought up the conversation of a Roth versus traditional IRA, or just Roth versus traditional in general. And then we went down the path of, hey, what are some better just key steps for somebody to get going? And brokerage account and a Roth IRA account, obviously majority of the money go into the brokerage or high yield savings account to build liquidity. And then we kind of just went through those key things. And so now we are at the point where we're kind of going to look at what does that look like, Roth versus traditional, and then obviously Richard's perspective on things and just your own experiences. So again, welcome, Richard, to the show.
Thanks for having me on. I got my camera working again, so my dignity is back, and I've matched your quality here, so I'm excited.
Man, I love it. I love it. I need to get wherever you get your shirts from, by the way. I love that shirt, man. It's just it reminds me of like a nice, like, hey, I'm back in California. I'm about to grab my skateboard and like just go chill kind of thing.
On the beach, it's just a beach
Yeah.
shirt. Indiana, not a lot of beaches here, but we can pretend.
Yeah, that's awesome. There's not too far between you and a beach, just a quick flight, right? That's
Right.
what I always tell myself. But
Exactly.
so let's dive into it. So let's talk about why somebody would do one versus the other. And before I do, I always want to give you a chance to kind of talk about what you've seen. Obviously you've mentioned like you're investing into your Roth IRA right now. I'm just curious, right? Like, so you are a dentist, right? I always hear the secondary conversations, even if I'm just like having like just drinks with friends who are dentists and their clients and just kind of hanging out. But I'm a financial advisor, so I never really have the true undercover experience, right? And so tell me, like, what are dentists talking about for finances? Are you guys ever bringing up this topic? Is that even a thing or?
I mean, the funny thing is it's you just look at Dental Investment Group. Like
Yeah.
we want to, we're either super intimidated, so we don't touch it,
Mhm.
or we're chasing like the better deal of like, oh, okay, are you trading options now, or
Yeah.
like you're
Yeah.
following some podcast or getting some newsletter and you're like following stock pick recommendations. You're how much are you in crypto? Like,
Yeah. What's your alternatives percentage and are you doing?
yeah, and bulls versus long-term buy and hold
Yeah.
versus commercial versus whatever. So, I love the because once you go the other way and you say, you know what, I'm just going to go pretty passive index fund, which I'm going to keep
Mhm.
coming back to that because I'm such a huge
Yeah.
fan of broad recommendations like that for most dentists. There's a lot less to talk about. You just need to make a few decisions and put things on autopilot. And so then the financial things, really it comes back to practice stuff and practice growth. But like these types of conversations, I would say never come up. Like
Yeah.
what Roth
Not
versus
even
stock
once, just
market,
never.
401k, unless you're about to make a decision for your practice of like, okay, guys, time to roll out a 401k plan or
Mhm.
safe harbor or whatever. I don't even know all the words. Like you just know enough to like, I think that's the right word for this
Yeah.
situation.
Yeah.
Um, and then you're just looking for recommendation. Who do you work with? What did you do? And then it never comes up again.
Yeah. Yeah. Okay. That makes a lot of sense. I figured that was the case, but it's always fun hearing it from you, especially the different words. Like what word is that? Yeah. The
Yeah.
funny thing is that I always get on my end is when I'm explaining it to someone, we'll say, yeah, well, I know what it is to me, but what do you think it means to you? And that's
Such
like
such a BS response. I love that.
yeah, that's like ego, like, hey, I don't know what you're talking about. And it's like, okay, I probably need to re-explain this or explain it differently. But yeah, so and I agree with you. I think most of the times what I'm getting from a lot of clients when they come in is kind of like, hey, I want to talk about the sexy, cool stuff, the shiny new object. And then after there's been a series of wins and losses that somebody's kind of gotten and they've kind of gotten a little beat up, sometimes they'll come back and say, "Hey, I was wrong. I want to do the prudent thing and just kind of look at indexed accounts or index funds." And vast majority of people, such a great option. There's a couple situations where it's like, "Hey, we could be a little bit more sophisticated here." We do a little bit of direct indexing, which I know we've talked about historically, but that's basically just taking an ETF and then directly holding it, where you dissect it and say, okay, Apple's in this. We're going to hold Apple independently so that we can take tax loss harvesting. Kind of don't want to go off on another tangent, but
Yeah, back to like speaking a foreign language for these guys,
yeah, yeah.
and
So
we're gonna go down a
let's
rabbit hole.
yeah, let's stay on track here, and we can kind of dive down that another time. But yeah, so going back to the basics, a Roth is you pay taxes today because you're investing after tax dollars. And so I receive, let's just call it $300,000 in income, and I invest $7,000 into my Roth IRA. I get taxed on $300,000 of income by the IRS. With a traditional IRA or a traditional investment that's into your 401k, the $7,000, so I make $300,000. I have a $7,000 investment into that type of account, which, let's just say it's a 401k. $7,000 is coming off my income, right? So I'm only going to get taxed $293,000. Obviously you're going to have a CPA help you on other deductions, but that's kind of the key differentiator. Are you going to pay taxes today, or are you going to pay taxes in retirement, age 59 and a half plus? It's kind of what we're talking about, and why it's important. And so, pop quiz for you, Richard, and I'm putting you on the spot. So just kind of, no
Not
worries.
afraid to fail publicly,
Yeah.
so
Yeah.
we can.
No worries. You can always phone a friend, right? Phone a friend is
I'll just be like,
perfectly
I know
fine.
what that means to me, but what does it mean to
Yeah,
you, Ian?
exactly. Exactly. What in today's tax rate environment, or let me ask you this question first. What is the federal tax rate currently? Do you know? For the
Well,
highest tax bracket?
I don't know. I would
Okay.
guess like 35, 40%.
Okay. So I mean, you're right on the money, basically. Like 35 to 40%, you're 37%. So you're right on the money.
Whew.
So one win for the good guys. Would the real question here is is that historically considered low, normal, or high compared to historical taxes in our history?
I mean, I want to say high, but I've not been an adult long enough and saving and paying taxes and paying attention long enough to like know in my career where I've had to think about. I mean, especially as a dentist, you spend 10 years of your adulthood through undergrad and dental school and other things. So, and then I was in the army for 6 years, so we definitely didn't make enough money where I'm like worried about lowering my taxable income via various things. So yeah, I don't know in the last 10 years of any hikes up, but I can't imagine that it was like higher once upon a time and we're like coming down. That seems kind of impossible.
Yeah, it would seem impossible, and it would seem really interesting, but it's actually really low. And
Hey, see, I'm failing on
yeah,
air. I'm
it no, no,
incorrect.
no, and that's actually, if I ask 100 dentists, they typically say the same thing. There, because in the most recent history, so just looking at a chart here, as of like 1988, so that'd be most, you know, 40 years and younger, 40-year-olds and younger, the the tax rate has been relatively the same, right? Around that 37%, I think it was in the high 20s in 88. But then before that, it actually was relatively high. It was that highest marginal tax bracket in like 85 was nearly 50%. And then in the 50s, it climbed all the way up to, and this is remarkable that the US population allowed this, in my opinion, but it was all the way up into the 90s. So your
What?
last dollar, you were giving nine 90% basically to the government, which is wild to me, completely wild.
Which since we're talking about this, I had a misconception a few years ago, and you just said the last dollar. There was a
Yeah.
part of my
Yeah.
brain that was like, oh, when you go up in tax brackets, then you have to pay all of your money at that higher tax bracket. But then I realized, no, no, no. Marginal tax rate means that as you go past each threshold, then on each dollar you make, you're taxed at that higher rate all the way
Yeah.
up to that maximum. And then all of the dollars past that point are taxed at that rate versus like, crap, I don't want to go above a certain amount and then retroactively all my dollars are taxed at that. I don't know why. There was just a little nuance that I just didn't understand until like 4 years ago.
Yeah, and I mean it's super common, honestly. And that's a yeah, key thing to be aware of is like that first tax bracket, you're getting charged 10% on that money. And then it goes up like 12%, 22%, 24%, 32, 35, and 37. And you're really not at, and these are a little bit old, but you're roughly at like 730, 750, I think, which you probably pull up.
700. Once you're past that point, then you're paying the highest, the 37,
Exactly.
everything
Yeah.
you make.
And sorry, actually, let's see for that's for I'm referencing married filing
Married joint.
jointly here. And so yeah, it's 751 $600. And so anything underneath that is going to get taxed at a lower rate. Anything above that's at 37%. So, and I ran these numbers. This was last year for a conversation I had with a dental society. And if you made $1 million, right? So if you made $1 million, what were the taxes owed? It came out to be right under 300,000, right? And
Okay.
so you're
Effectively, is it called an effective tax rate when you
yeah,
like look at your
yeah.
taxes overall?
You're speaking the language, Richard. You're speaking the
Okay.
language 100%.
Okay.
Yeah. Yeah. So if your effective tax bracket or your effective tax rate rather would be in that situation, it was 29.6% was what it came out to be. So, but essentially, so then like it's super important. Like I bring that up because it's super important to understand like where are we at in today's history, and do we believe taxes are going to be the same, lower, or higher by the time you get to retirement? And there's a lot of things you could argue like about, this administration and future administrations and what's going to change, what's not going to change. The one thing that we struggle with as a country currently is just balancing our books, right? Just overspending. And so at some point, we will need to start chipping away at our deficit and at our country's debt. And to do that, you have to increase revenue. Now, within that, there's only a couple different things you can pull on as a country. Now, they've done two that we've actually never really seen, which I thought was really interesting this year. One, they invoked tariffs, and so that's another form of revenue. Two, they've actually bought, instead of giving grants like what they've done historically, they bought a percentage in a company in Microsoft, which is wild to think that's never happened. Usually, like the government subsidizes like an Amtrak or something of that nature just to provide a public service. But anyway, so there's two revenue streams that came out of nowhere that we could have never planned for. But in essence, the other revenue stream that typically gets pulled on is taxes, and raising taxes to then create more revenue. And in raising taxes, then if you're paying, let's just call it 37% today versus whatever the future number may be, is there a chance that taxes get increased? Probably so. I'm okay to be wrong in that. I think I'd also say I'd rather know what I'm paying today, right? And so there's also, again, this is where the asterisk always comes in. Like every situation is different. There's some situations where, like, if you're in the military, let's say like you're a military dentist, and there's probability that you can claim a disability or something of that nature in the near future, then your income may not be taxed, and so why would you pay taxes while you're getting paid currently under tax? So like there's all these little small caveats, but in the short of it, generally speaking, if you live off of a similar income that you're making currently and you plan to live off of a certain income that you'll make in retirement, you got to figure out, are taxes going to be higher or lower in retirement? And they're probably going to be skewed towards higher.
So all of this, and I think people might be confused at this conversation, is a discussion of should I fund a Roth IRA or not? Does it make
Yeah.
sense to pay tax dollars today with the assumption that tax dollars will might be higher because we're overspending as a country, the deficits or the deficit's growing. So therefore we're hedging our bets. But even if we're wrong, like number one, 7 grand a year is not a lot to
Yeah, that's
like
right.
wrong on, number one. And number two, like what are the odds that taxes drop from like that 29% on a million effective tax rate to
Mhm.
like 20%? Like I just don't see the drop being dramatic. So like the potential downside, what's the potential risk of number one, this is a small, if you're starting to get up into the 10, 15, 20% savings rate and you're making a decent income as a dentist, which would be awesome. It'd be really good if you get up saving up that kind of money. This is not a big amount of money to kind of bet. And so I think it's in my mind, it's just one of those like just shut your brain off and fund your Roth IRA. Like,
I
like
love the way that's communicated, just so simply put. Yeah.
and Ian will tell you if you're a special circumstance. And so
Yeah.
like
Yeah.
yes, they exist, but in general, I found in all of my like talking with financial people who care about this, very few people who are arguing, if any, against it. I feel like it's more like individuals who are not in the financial world are like, yeah, well, we can't predict the future.
Yeah.
So for me, it's just one of those like almost non there's so many more things to worry about, in my opinion, than
Yeah.
I fund this or not. Just like go ahead and freaking fund
Yeah.
it.
Yeah. Just go ahead and fund it and just get over it. Yeah. I love that. It's super easy, super simple. And really the math plays out, right?
Yep.
And I would argue again, for the individuals that are probably arguing against that ideology, it's probably because they want to take the tax write-off in that given year, right? And
Right.
it's kind of a like just human anatomy of I want what I want now and I don't want to have to worry about later on. So yeah, I mean that's a really easy way to put it. And I love that. And then quite frankly, just kind of going again to your $7,000 Roth mindset with the Roth IRA. So you have money that you can put to your Roth 401k if you have one. If you're a practice owner, you should definitely look into one. It's super simple to make an amendment on your 401k and to implement that. And then that allows you to put 23.5 into your 401k. That's Roth dollars. And then you can do the additional 7,000 in the Roth IRA. And so that's when it gets like, hey, now we're putting $30,000 in. But then if you look at subsequent places you're going to put your money, like a lot of people, which just kind of goes into another, I don't want to steer people where it's like, hey, this is super confusing, but as you get later in your career and you have more money to invest or that, ideally you're putting 15 to 20%. I know that's very difficult sometimes, but ideally that's where you want to be. But if let's just say you're putting 10%, but you're making $1 million, well, that's still $100,000. Well, what ends up happening is you start stacking in your 401k plan. And so you do your 23.5 as an employee, and then you do your employer match. And your employer match, like there is because of which I'm going to go in the weeds here, but there is because of a newer rule as of 2021, the Secure Act 2.0, where you could do employer match as Roth dollars too, but it's not really a thing. Not too many people are doing it. And you also have to then now pay more taxes out of that. So not too many people are doing it. But so you have your employer and your employee contribution, and then you can do what's called profit sharing on top. And the profit sharing that you're giving yourself, the maximum that you can put in is going to be $70,000. And so you're putting in $70,000 between your contribution as an employee, the employer contribution, and the profit sharing. And so if you think about it, even in the context of, hey, I'm maxing my 401k to as the most I can, the 23.5 is it's the lesser of the percentages on the $70,000 total investment. And so in the least, you're at least just adding where you're going to have Roth dollars in retirement. So you're diversified and you have different tax buckets. So what I guess I probably gave a little bit too much there, but for you and just kind of thinking through everything, Richard, I know you see it through the lens of a dentist. You see it through like like, hey, let's keep it simple so that people can understand it. What would be some key things that you're pulling away or you're saying, hey, Ian, here's what I would really highlight?
First off, I'm learning on air because like I don't know the 401k Roth. Like that was new to me. I didn't know the limits on
Yeah.
that, how much you could put into that. And I didn't know this other component that lets you go further. So, that whole just fund it. Okay, the conversation is more nuanced because if you are looking at putting that much money in and paying that much taxes on those dollars now, then you really got to be committed to this idea that I want post-tax untaxable dollar. There, there's something that feels good about not paying taxes now, which is the deductible stuff. But I think my point earlier of like my misconception of breakpoints, where if you're under a certain amount, all of your dollars are taxed less or more, versus no, it's just the marginal dollars are taxed at that higher rate. Then
Yeah.
all of a sudden, it's not life or death. You're gonna have to pay taxes on this at some point. The the flip side of that is you have a high income now, and potentially in retirement, you're going to be withdrawing less and therefore have a lower income at that point in time. And so that's where I think some people make the argument the other way, is my thought process. Is that fair to
No,
say?
no, that's 100% fair, right? Because if you're if you're in a situation where, and this isn't always the case, this is like typically less often than it is often. The average dentist that kind of comes through our doors is making between like 300 and 500 as a household. And so they're they're in a situation where they're probably living off of that pretty substantially, right? Like where they're living off of 20 to $30,000 a month. And that's because you get accustomed to a nice house, nice cars, your kids might be going to private school, you just have memberships, things of that nature, and you buy good food that you enjoy and you entertain yourself, right? So like
You
there's
go on
that.
vacation.
Yeah, you go on vacation, right? And then so like in that scenario, you're assuming that your cost, and this is probably another conversation, but your cost in retirement is usually about 80% of whatever your cost is today, like on average, right? Like you can take out your mortgage, depending on where you live, that might be a bigger number. If you're like in a coastal state like California, or you're in a place that's like a big city like New York, like it's going to be a bigger number. But generally speaking, your cost of living is going to stay close to 80% would be the metric that I'd say like, hey, you need to probably plan for this because, and it sometimes even is more because now instead of only having the weekends to spend money, well, you have 7 days a week, right? And like most people, they want to keep themselves busy. Now, for the person that is kind of like an odd person, right? Like that's kind of like, hey, I'm making really good money, but I'm just stashing it. Like I'm not really doing anything with it.
Whirling it away.
Yeah, like their hobbies are growing a dental practice, right? Like that's like that person is a unique person, and when we have some of those, and it's always interesting because it's always like, hey, you got to start spending your money. Like go do something. Like go on vacation,
I was
right?
zero concept of like your
Yeah,
now is going to be better deployed than your money when you're 70 or 80 because
yeah,
you can enjoy the things that are worth enjoying now that you can't enjoy later. And so
100%.
being on the beach in the Bahamas when you're 70 or 80 is not as fun as being on the beach in the Bahamas with your kids now.
Yeah. Yeah, 100%. And then quite frankly, from what I've seen from those people that are in their 70s, they don't spend their money anyways, right? Like it's so interesting. I had to really have, and it was a super meaningful and impactful conversation, but I had to tell someone like, "Hey, like you have more than enough money. Like take your grandkids to Disney World." Like that was like kind of their big question is like, "Can I leave money to my heirs and take them to Disney World now?" And it's like, "You have way more money." And so anyways, I think some people just have a scarcity mindset, which is not like a bad thing. It's just different mindsets where they are concerned about running out of money. But sorry, in short, those people though are in a unique situation where if they're not really living off of much right now, then it does change things, right? Like if you're a high income earner, but you're not spending a bunch and you don't plan on spending a bunch in retirement, it could change things. But I also would still argue at the fact of like you're a business owner, you probably have more deductions right now. You have your mortgage, you have all these different levels of things, right? Which is another talking point, but you could leverage like things like the Augusta rule, where you're renting your house out from your business basically, and doing these different tax plays. And so, and on one side, I'm saying, hey, Roth is probably a good default. On the other side, I'm saying it's still probably worth like calculating it, but you're still most likely you're going to land on the Roth default as well. That'd probably be my like, hey, if you're going to make an error, you're probably not going to want to be in retirement still having to pay taxes. Because if you do make the error, let's say you put all of your money in traditional, and let's just assume you have, let's assume you've like, you're a rock star and you've saved $10 million, right? That's probably a lesser percentage of people, but let's just say that's the case. Well, if there's a 10% tax change, that's like you losing 10% of your account, right? Like traditional IRA or traditional 401k counts as ordinary income in retirement. And so if you have $10 million in your traditional account when you retire and they raise taxes by 10%, well, now you just lost $1 million in your account. That really hurts. And there's no way around that. Versus if it's in Roth dollars, you have full control. There's nothing the government can do to change that. And you can predict your retirement without anxiety kind of looming over you.
I like the psychology of tax-free dollars growing
Mhm.
because people talk about, and I apologize for this term, people talk about they want like FU money. Like they
Yeah.
can just, you know, they don't need anything, they don't need anyone, they're financially independent. And I feel like if you have Roth, if you have 10 million, you know, in theory in a Roth, which would be really cool if someone achieved that over time, which is, you know, hard to do because you need the number of years and you got the limits going into it and what you're investing in.
Yeah.
But like
Yeah.
that would be an example of like true FU money, both to the government and anyone else. Like no one can really touch that. And there's just some, it's like America. It just feels good. I don't know.
Yeah. No, and I agree with that. I mean, he- most people, and again, my thought process with financial planning is how do I achieve autonomy for me? How do I get to make a choice on what I want to do at any given point? And having money that's tax free is partially doing that, right? It's kind of that what you're saying, like that FU money, where you can kind of say, hey, look, I don't really care. You know, they can change the laws or change the tax code, not the laws. They can change the tax code and it's not going to affect you. And so that's what most people want. Most people want peace of mind that if I want to be autonomous, I can, right? That's the whole point of liquidity. If I'm in a pinch, I have money. If I want to buy a practice, I have money to do that. If, whatever it may be. So yeah, I think that's a good place to probably land at is the FU money. But what for you, Richard, what would be a couple of takeaways that you'd say like, hey, the listeners probably should walk away with these 1 or 2 points?
I mean, number one, the hopefully the I'm not the only one that just didn't understand the marginal tax thing, and hopefully that was helpful to someone. But I didn't realize the takeaway for me was how hard you could go into Roth with a Roth 401k and these other options you talked about. And, I think you don't know what you don't know in this stuff. And that's why these types of podcasts exist. And I also love that we're like getting in the weeds. Like we are not just surface level talking about this. It's like, okay, no, how do you actually implement this to a degree? What are my options out there? And we're building. It's like, okay, this is a fundamental decision of pre-tax, post-tax. And this does affect my thinking. It does affect my strategy. It does affect the structures I build up within my dental practice. And, do I have these savings options for me and for my team members, all of that. So
Mhm.
this is great. I love where this discussion's going.
Yeah, same here. And yeah, absolutely love this. I could nerd out on this all day. For the sake of my family, I don't because I may not never see them, but obviously kidding there. But anyways, Richard, great as always. Can't wait for the next time that we have you on. And yeah, I want to definitely dig into it a lot more and hopefully keep it simple enough where the basic people or the basics get addressed and then also dive into the weeds for those that want to go there with us. So thanks.
Awesome. Thank you, Ian.
Thanks for listening to Smiles and Cents. For more information, resources, and to schedule, visit dentistfinancialplanning.com. This podcast is intended for informational and entertainment purposes only and should not be considered investment, tax, legal, or accounting advice. Any opinions expressed are subject to change and may not reflect the views of affiliated firms. Investing involves risk, including the possible loss of principal, and past performance does not guarantee future results. Please consult your financial, tax, and legal professionals regarding your individual situation.